Ladies and gentlemen of the crypto space, we're back a week later. Took some time off. Monday, July 24th at 11:45 a.m. No better time to talk about the notion of crisis or crises, plural. When times are good, the opposite is that times become bad. When times are bad, the opposite is times become good. We're in a situation of relative calm, but the volatility, the indicators of systemic change are all around us, and crises are inevitable from here. The volatility has been muted, and that is something I argue is what they've been trying to do significantly to calm things, to allow the system to stabilize, to allow the securities to flood the planet and be converted into liabilities, dollars, and increase liabilities. That mutes inflation mutes volatility to a degree as well. The more supply facing demand, things stabilize. So let's look at some charts and we'll see generally what I'm talking about. Most important is move. We've been in a period of 18 months of a rolling top, and it's not going up. If it's not going up and it's stable, at least at an elevated value, it's the delta in volatility that causes shocks in the system. So obviously delta and volatility to the upside causes destructive shocks. Delta and volatility to the downside as everyone breathes a sigh of relief that a crisis is pushed down the road a little bit, but everything is cyclical. The volatility will return. And it's important to understand the time horizons that are involved in these macroeconomic phenomena. They have a capacity to mute volatility for an extended period of time. Years, 1, 2, 3, 4, 5, 10 years. And over the short term, that low period of volatility allows us to assess potential opportunity. What is working? What are the systemic changes occurring that will carry us technologically and financially into the future? The periods of volatility will be extremely destructive. You could expect significant depreciation across the board. But that should not, and in no way requires fear. It requires understanding that it's coming. There's going to be good times and bad times. So from a personal capital management standpoint, what do you do? What are the behaviors? What are the choices? Because when a volatility event occurs, the last thing you want to be doing is scrambling. I should buy, I should sell. The last thing you're doing is selling things during a volatility event. Why? What do you sell during a volatility event? You only sell for one reason. You need the liquidity. Do you need the liquidity, or are you selling for fear of depreciation? Are you selling because of a portfolio balance that is not necessarily the most significant measure of the success of a portfolio, especially from a larger time horizon? So that's why it is imperative to have these rules of the road, these strategies, these plans of action prepared beforehand. You want to know what you're going to do during a period of volatility before the volatility emerges. And you want to hold and own assets that are going to appreciate during periods of low volatility prior to the period of low volatility emerging. There is only one way to own something at peak or bottom. It's to have held it prior to the depreciation cycle. Now that can easily be confused with hodling. That could easily be confused with diamond hands. And there is an extreme difference between assets and the function of them in a portfolio. Capital gains assets, growth assets, and value assets. So the equation generally is simple between both of them if you intend to not necessarily take action during periods of volatility. It's one word. It's what is going to survive. And what will survive, to understand what has more likely than less likely to survive, is based on your understanding of how the macroeconomic system works. Now, there is going to be extreme changes, and this is a great post by Rectamides. So hit up this @ symbol, check over this post. He does a wonderful job at threading. And obviously he mentions the greats. Luke? I don't know this gentleman, but that was a heck of a series of statements. Lynn Alden, obviously. And one of my favorites, James Lavish, who understands the system in a way and presents it in a digestible way. It helps. The system is getting to the point of no return, as folks have been talking about with regard to fiscal dominance. Many folks will be confused with the words inflation being thrown around. And we've, over the years, broken down inflation from a currency inflation standpoint to a consumer price inflationary standpoint. And that's the terminology and breakdown we use to digest these financial assets we're exposed to in this digital economy, in this DeFi space. And that has presented us some great opportunities to suggest what has a greater likelihood of survival as compared to what is likely to die. The vast majority of companies, corporate equities, as well as crypto assets are destined to die because they don't contribute to something of systemic importance. And that's why we look to things that offer systemic importance, things that contribute to flows, things that provide income, things that provide function and utility. Now, we'll jump around with regard to ideas, and the idea at the moment in my mind is what are the things that are significant with regard to utility. Now, obviously, the concept of trading is a utility, speculation, gambling is a historic enterprise that is quite lucrative. I would define trading to some degree the concept of FX, foreign exchange, and traditionally that's in the context of fiat regimes or sovereign currencies. And personally, I think that's the biggest and most meaningful sector or industry part of this crypto space that we have been exploring. Now, obviously, lending and credit. Credit, I think, is one of the biggest enterprises in all of economics globally. FX is huge as well. The capacity to exchange a denomination of a credit that you have, of credit that you have taken. Someone has extended you credit in a particular denomination and you want to convert it to another denomination. What the hell do you think you're doing when you're converting Bitcoin to Ethereum, Ethereum to dollars, dollars to euros, euros to yen? That's FX. If you define Ethereum as a currency, why would you not define these things as a currency? It's just a definition. You can use it to pay for things. You can go to a grocery store and pay for things using Bitcoin and Ethereum, albeit there's frictions because of the FX involved in converting from one denomination to another. Now, there's obviously varying frictions depending on the tools and configuration of the systems that you have chosen to use to do these types of payments. But that's extraordinarily meaningful. especially going into the future cycles. We have come from a place where the vast majority of this space that we explore, the DeFi space, dies. ICOs were useless. They were mere IPOs in crypto form. And the enterprise did nothing, offered no systemic importance to the consumers, us. A phrase that floats around often is this time is different. And it is the case that this time is different in crypto markets, but it's not going to be what a novice would typically expect. A novice would typically expect appreciation, number go up. But that's the wrong thing to look for with regard to portfolio management. What you want is survival, and what I would strongly suggest people entertain, especially folks that have been following me for years, is the concept of cash flow. Is also the concept of not humbleness necessarily, because we all have a want for more cash flow, is to divorce yourself from significant appreciation. 1,000x, turning $100 into $10 million. That leads to unreasonable expectations. But cash flow can sustain livelihood. Cash flow can pay bills. Cash flow can be sustainable if it's cash flow from a very reasonable source that offers something of systemic importance, such as credit extension, such as foreign exchange, such as maybe a derivatives protocol or a training venue which offers entertainment and gambling and speculation. I'm too empathetic in regards to exposed to those assets. I'm not fond of trading. Trading is biological, as we've described, and it's a process of capitalizing on persons with less expertise, which is, it's not personal, it's business, and I understand that different folks will have different sentiment in that regard, and you take what you need and want in life, and the world is based on limited resources, and we're all in a scramble to acquire exposure or capacity to leverage those limited resources. And ultimately, at the end of the day, it is Darwin. So maybe my empathy inhibits my potential returns at times. But that's another rule. Don't fight your nature. If you fight your nature, you're in an uphill battle to make the best decisions possible. The best way to manage a portfolio is to find what fits your personality. If you have a capacity to trade relentlessly and divorce yourself from emotions, capitalize. It's not personal, it's business. And that's okay. And there's countless persons that have done extremely well. And I appreciate that. And it's just not me. So I'm very grateful because that was the name of the game. That was the only game. In 16 and 17 and 18, everything came down. And 19 was maybe comparable to where we are now with a lull in liquidity conditions and volatility, maybe more so. That was the only game in town. But now we actually have products and services that contribute to actual systemic importance from a macroeconomic standpoint. And that's quite extraordinary. So portfolio management, capital management is what you own, the composition of the portfolio, concentration versus diversification, and what I would argue, cash flow. Because if you have cash flow, what's the significance of the value of the portfolio? Is that the most important metric? What happens if the value of your portfolio declines 25%, but your cash flow doubles? You're able to buy twice as much goods and services on a Friday, You're able to save the liquid portion of your portfolio at that much of a faster rate because you have that much more income. And maybe that is what's most important because that's why people work. On a Friday when you get a paycheck, that's cash flow. So what's the difference between cash flow from work and cash flow from assets? Nothing. The only difference is one, you have to expend physical energy, and one, you had to understand macroeconomic phenomena to identify opportune capital allocations. So that is the most important thing with regard to portfolio composition. The free liquid portion, which is for consumption and spending, the cash position. Pick your denomination, and you could treat your liquid part of the portfolio from a capital gains perspective and swap using FX between Bitcoin and dollars, Ethereum and dollars, Ethereum and euros. And look, if you had dollars in 2023, you lost value, purchasing power as compared to euros. And the yen is up, and the yuan is up, and the dollar has not been doing very well this year, as depicted by just the general perspective, the DXY. DXY has come down from 114 to 102. So the dollar isn't always the appropriate denominator for the portfolio. But this is why the technicals matter, and that's maybe above and beyond what I wanted to talk about today. But generally speaking, between this chart and this chart, and especially this chart, this is the 10-year, and if you zoom out to the yearly on the 10-year, the structure is broken. Structural change is inbound. Now, it's imperative to understand going forward. James talks about this, James Lavish. And everyone talks about this. Luke Groban talks about this. And Brent talks about the end game for this. The whole system is in the end game. But the end game, these macroeconomic phenomena, don't occur in days, weeks, or years. They occur over 5 years, 10 years, long time frames. So a lot of things, obviously you have time, and they will take a decade to start to see the structural change that's occurring. And you might want to change denomination. But the hard thing is that between now and 5 and 10 years from now is the volatility that give you FUD about the directionality that things are changing. But the change is occurring. And what's important is not necessarily conviction. It's to a degree you want to ride the waves to capitalize as best as possible. So dollar denominated in 2023 was not opportune. But you didn't need to necessarily convert from the dollar to something else. What matters is at least identifying that something could have been done. And then the next time the volatility occurs or a directionality change occurs, you can adjust accordingly. What matters is always the composition of the portfolio, that you have a free liquid cash part of the portfolio that you could sell to buy goods and services, changing the denomination opportunistically if possible. And then the income portion of the portfolio, because that's the most important thing. That's what changes everything relative to the standard human, the NPC, the non-playable character that works for income. And it's like, what do I do with that income? Do I pay bills? Do I buy food? Do I pay rent? Do I invest? What is different than that? Because we want to be different than that. And that's in good part why I started this stream. It was the journey from that to where we are now, and it's quite a different conversation now. And I remember what we did in earlier years, the beginning of the 2010s, 13, 14, 15, 16, and 17. And then in 2020, it's taken a decade for this picture to become clearer about how not to be frightened or just erratic when volatility presents itself, or how to be extremely rational in assessing what to own, why to own it. And we've gotten to that point. We've gotten to the point where it's basically methodical. And I don't deviate from how I view things at this point. I will adjust accordingly, but adjustments take time. Overall, this chart is so meaningful that the whole structure of the system is reorienting. Change is scary, but how do you prepare? You prepare by being protective, defensive. And with a liquid portion of the portfolio, you can make offensive decisions depending on the structure of things. Let's go back to the DXY for a second. And I think we're in a good position. I love this chart. This might be my favorite chart. And this is on the 12-month. This isn't even the 6-month. This is on the yearly. Now, this might not be a top, but structurally it looks like it's a top. And that indicates directionality. System is coming to an end in its current form. But that end could take 10 years, 15 years, 20 years. The amount of dollar demand internationally is absolutely extraordinary. And the globalization is peaked. So that means the exporting of dollars, it's not working. It's not going to be able to meet demand. So there's no way to know what will play out. But if they want this system to persist for a period of time longer, whatever that period of time is, this chart needs to come down. This chart needs to come down along with this chart. It needs to come down. And to me, that's a geopolitical observation. If it needs to come down for the entire game to continue for a period of time, it's a collusion process between sovereign nations. And the alternative is what has been circulating to some degree from a fourth turning perspective, war. If these charts do not come down, it will cause a resource fight. What the hell do you think is going on in Russia? It's a fight over resources, land, territory. Why do you think they want Ukraine? Obviously from a protection standpoint, but it's also the natural resources. It always is. And land for humans, for building and productivity. It all reduces to resources. So if these charts go up, a fight over resources ensues. And resources including the dollar. You need the dollar to pay the debt, otherwise countries around the world collapse. Collapse involves chaos, incivility, violence, and no country wants that. So a lot of understanding these markets is understanding just mere causality and human expectations, human desires. Nobody wants violence. No country wants violence. So they will do what they need to do to avoid it, if they can. And if they can't, that's why you have the liquid portion of your portfolio. And that's why you have MREs, guns and ammo in the garage. Tapsies in the house, tape pusher, pleasure, create your shape. How do we know we won't be cut off from Curve Finance claiming rewards? Because the contracts are immutable, and if you have access to the internet anywhere on the planet, you can acquire it. If they shut down electricity, they would have to shut down electricity on the planet, because you could execute on an Ethereum node in Great Britain, in Singapore, in Pakistan if you want to access the contract to claim the rewards, and you could convert those rewards using various FX platforms that are accessible from any country, 195 countries on the planet, into any denomination you want. Spending of those currency units, those liabilities, is another story. And that can be complicated, but there's a variety of things that come to mind. That is a complexity. But I don't fear that much I think that's navigable. Crypto is not a U.S. market. T2 Sugars, what are your views on the convex platform? Does it still have legs? Massive legs. So liquidity goes back and forth. They're opportunistic, which is okay. It's not necessarily a bad thing. They're trying to do the best they can for their protocol. And they have taken a liking to Maverick. And that's fine from a stablecoins perspective. They need the deepest liquidity. They need the best swap rates, the lowest spreads, and they're finding it. What happens with Maverick, I don't necessarily know, but I do know that an emissions protocol without consumers, without excess supply sterilizers, is going to continuously depreciate over time. And that's exactly what we see with their chart. Not to be too declarative of their inevitable demise. That was the start of curve. It was just a hyperinflationary implosion, and that's what this token is doing. It's expected. It's just boosted LPs. Obviously, their LPs are extremely efficient. Albeit Trader Joe is coming to mainnet, from what I hear. So there'll be competition in that regard because Trader Joe has some nice LP curve management capabilities. And that's what Maverick does. And that's why Maverick has the volume it has, because it's offering the favorable swap rates. But from an investment standpoint, if there's no consumers of the boosted emissions, this thing's going to just go down. It's what Curve did. It's what they all will do. That's what any emissions where the supply is increasing and there's no arrangement, spoken or unspoken, by other participating parties to remove excess supply from circulation. It will just continuously go down. So they did note in their docs that if a bribe market comes online, yeah, of course, that's the point. If a bribe market comes online, you have the emergence of a federation of sterilizing consumers. And that's a big if. And until that if occurs, depreciation will continue to occur. So convex very much has legs. It's a critical component of the Curve Federation. All the components are critical, and all the components that are consuming Curve now have an existential tie to the base layer. So it's a synergy. It's a phenomena of codependence. They are required to consume excess supply for their own existential survival, or however you want to define it. And yes, it very much has legs. And this is not a period where everyone sees the calm in the market. They see the little hints at appreciation. And I don't expect significant appreciation in the short term. I'm still in a period of survival, meaning I expect optimistically, for me, horizontal price action. If I see horizontal price action, I'm like, all right, they're doing exactly what they need to be doing. You know why I'm still in a period of survival? Not that. If we go over to here, you go over to here and you go to stables, we'll see if we're in a negative sum game. Still a marginally negative sum game. And bear in mind that's from all, and Tron is a bit outside the scope of the DeFi markets. But if you go over to mainnet, you're a minus 1.13%. Do we expect appreciation? The whole system is negative sum. Your entire process of capital management is based on flows. It's based on being in a market that is receiving inflow of capital, so you have a greater likelihood of capturing a portion of these dollar liabilities. Dollars. Isn't that what the game is? Or just a currency unit, because that's the mechanism of payment? You walk into a supermarket, that's the whole point. That's why you're doing all this. So you can make a payment at a supermarket. So you can make a payment of a credit card bill. So you can make a payment of your mortgage payment. So you can make a payment, and those payments require currency units. So this entire game is about currency units. So you can make payments, so you can wake up in the morning and finance your life. So on a Friday, when you get a paycheck from work and you get a paycheck from crypto, one day maybe your paycheck from the assets you own is greater than the paycheck from work. So you can make different decisions. Maybe you don't have to work. Maybe you don't like your job and you're like, all right, I have enough capital income from this place that I could stop the W-2 employment, find something else, find something that I enjoy. Freedom of choice. That's why you're doing this, not just the overall portfolio to make as much money as possible. And that's what I focus on. So that's a bit of a digression, but I think Convex has a critical systemic role in the curve ecosystem, and it's misleading current price action. What matters is survival, and that's why I look for critical immutability, because anything that is critically immutable will be available when this number, this pink number right here goes up. When you see this number at 10% a week, up 100% on the month or the year, do you know what's going to happen to basically anything that survived? Anything that survived is going to be receiving massive capital inflow because it survived. It's a name and a brand and a function of systemic importance that survived. You're in a period of survival. That's the bottom line. Brian, happy Monday. A pleasure. Sarko, hey, hey. Cap's back. Yes, back in action. Raul, Drew, do you suggest any books or readings? I earlier in the stream, I posted Rectomedes, a thread that he just posted that has some good persons in the thread. And the content of that thread is mission critical to understand, to navigate these markets and manage your capital. I mean, the whole title of the stream is capital management. So it's not just navigating crypto markets. To navigate crypto markets, you have to understand the macroeconomic system. And ultimately, the reason this old man, not too old, I'm 40, I look to the crypto markets because this is where I see not just the most potential, this is where I see even reasonable potential. I don't see reasonable potential in equities markets. All I see in equities markets is flows of just like perma flows, like 401ks and financial advisors that just dump people into the things that are outperforming because they're doing well. Capital flows from underperformance to outperformance, and that's what's outperforming until it's not. I just don't like that. I don't like flows. I don't like something that requires a market that isn't offering what I'm looking for. And the biggest thing that I love about crypto markets is no people. Get people out of the equation. And that to me is the ultimate investment. A financial platform that provides credit and FX functionality that has no humans involved at all. And it just pays. No people, no board, no dividends, no vote. Well, there's voting, but there's no voting with regard to dividends necessarily. And it just works and pays. That's the most significant investment I could possibly think of out of everything in traditional finance. You can't do this. You can't buy anything that offers FX swaps in traditional finance where that's where the cash flow comes from. Doesn't exist. You think when you buy Chase or whatever bank, that's where your cash flow comes from? You're getting bullshit dividends. Whereas you have exposure to, you could actually lend. You just lend. You get 4, 5, 6%. You're not getting 4, 5, 6%. All right, now you are, but that's because the banks and their money market accounts, and they're exposing you to the interest rate of risk-free debt positions, sovereign bonds. That's not cash flow necessarily. You could have a whole conversation about that. But I want the cash flow of these protocols, because if the cash flow through these protocols goes asymmetric, what do you think the cash flow does to your portfolio? Raul, Drew, I hope that helps. Eris, hope you are well. I'm okay. I'm back in biz. Not sure if you saw my tweet replying. Do you believe CCIP No, it makes all chains one chain. Seamless cross-chain interoperability. That's what CCIP does. CCIP is cross-chain messaging. CCIP is chain link of layer 0. I mean, generally speaking, implementation and the whole conversation about the distinction between the protocols aside, that's what they do. Chainlink is massive. Chainlink changes everything. And just because the technology changes everything doesn't mean it's a good investment. It's a speculative investment that cash flow is going to be given to you. So my sentiment is I'd rather see a system that has low cash flow but is immutable, and we know now that the cash flow is locked in. We're getting cash flow now, but it's low. And in the future, of that cash flow increases, we're going to be already exposed to it because that's the design of the system. But that design of the system doesn't exist for Chainlink. Folks are speculating that the structure of the system will change such that cash flow will be available to them. You know, FUSDC and V.1 staking, that there will be link staking for every pair to secure the structure of their implementation. Okay, it's speculative. It doesn't exist right now. And then folks will be like, all right, but when that becomes available, you're going to be buying for 100x on the money and Link will be 100. I'm like, all right, I don't want the appreciation. I don't want the risk. What if that cash flow doesn't emerge and the only way to capitalize is to liquidate your Link? And if you're not getting more Link, you'll liquidate your Link and you won't have Link. And that's an issue with regard to just investments in like Bitcoin. It's not an investment, it's a cash position, which means if there's no cash flow, a return, a yield, it's not an investment. It's cash. So fine, Link may mature into something that is a form of appreciative cash, where it has a tendency to go up in value because maybe there's more being removed from circulating supply, and becomes deflationary to a degree, and that's the balance of the monetary forces. Still doesn't make it an investment. It makes it a form of cash. And that's a critical way I've broken down my capital management, my portfolio strategy, construction strategy. What is an investment and what is cash? Changing the denomination of your cash I don't define as an investment. I define it as cash. I'm just changing the denomination of it. So if you change from US dollars to Bitcoin or US dollars to Ethereum, which I do, I don't consider those positions investments. They are cash. Maybe that helps folks simplify the way they look at a portfolio. An investment to me is in a company to own something that is paying me a return on my capital. That's how I've structured the portfolio. Hope that helps, Eris, in the sense that CCIP is now somewhat a base layer and there being less of a need to differentiate between chains. Just curious on your thoughts. It's a big deal, and it's the seamless cross-chain interoperability narrative that I had as a pinned tweet for quite a while in 2021. At some point, you'll be operating on one chain but executing on all chains, and you won't need to know what chain you're operating on because it'll all be seamless. And that brings into question what's the significant or the systemic value of all the varying chains. And, that's speculative, and that's going to be interesting to see what plays out. But that doesn't really change much of what I just described regarding investment versus cash. Create your shape. You're welcome. Very welcome. Sergio, present and accounted for. Jesse, a pleasure. 24 people in the stream. 8 likes. Hit that thumbs up button. We could do a little bit better. I appreciate it. Let's take a look at a couple of charts and we'll wrap it up for a Monday. Oof, this is straight down, unfortunately. So the DXY bounced back to like 1013, 1014. If we go over to the daily, we could see that a little bit better. But it did print a lower low for the year actually. And if you notice and you zoom in, I think it's getting rejected on the TWAP. 6 days left in the week. The end of this week on the daily chart will be interesting because the end of the week, Thursday, look, on a Thursday back in May, it breached. But if this closes below the TWAP at the end of this week from the daily chart perspective, it would indicate rejection. Rejection as compared to earlier this year was not rejection, it was breach to the upside. That would be resistance holding as resistance, and that would be confluence suggesting directionality continuation. If we don't see a leg above the TWAP from a daily perspective, the bounce back in June last month was weak, and it got rejected. I think this is the 200 EMA. But it'll be nice to see a rejection here on the TWAP on the daily, but then obviously we zoom out and it's a completely different perspective, and it's like check back in 2024 or summer of 2024, January of 2024 for some more information. But structurally, my expectation is the collusion of the global sovereigns requires depreciation of the dollar for the game to continue for X amount of time. And the equation is very simple, as I stated earlier. It's either that collusion works and everyone agrees they'll devalue the dollar, the game will continue, debts will be paid, the global debt construct will continue to exist and maybe expand for 5, 10, 15 years, or we're going to get into a conflict over natural resources. Because if the debt construct doesn't expand, that's when things start to hit the fan, so to speak. T2 Sugars in the house. Appreciate you guys. We could take a look at curve depreciating. What matters is, to me, that it wasn't a position, it's a purchase. I don't see any indication of reversal, albeit this is a bit of an inverted hammer coming off a rather large hammer. So it did push up above the 10 SMA on the monthly for a period of time. It needs to get above the TWAP. You see a breach above the TWAP. One, it'll be a breach above this trend line as well. So that's been a pretty steep depreciative trend since, zoom out maybe, there we go, since February of 22. That's a year and a half at this point. So you start to see curve at 90 cents and it breaches. You see curve at $1. You might be in a position for directionality change to the upside. Still has a very well formed inverted head and shoulder structure, and the overall macro structure of this chart is the Adam and Eve pattern, which is still quite decent. A rounding bottom with the peak, something like this, peak, and then the rounding bottom. So that's certainly Adam and Eve presentation, inverted head and shoulders, and it's not depreciating. So the most fascinating thing about a chart like this to me is that it's not depreciating. This is an emissions protocol, and it's looking back over here. This thing is straight down, but we don't discount that because this was straight down as well, and that's where they are. That's where that protocol is. And they're pre-Federation emergence, and I'm not really in a position to expose myself to this again. It was an extreme time when Curve launched, and we were trying to assess what the hell was going on, and nobody really knew. Nobody knew what the hell a federation was back then at all. So that's been a wild ride since October of 2020 to assess all the things we've learned about macro financials and what this system really is. Total 3, so this is total market cap of everything minus Bitcoin and Ethereum, looks structurally interesting. It pushed above the monthly TWAP, so that's promising. The same pattern that we've seen in the last 2 months is the hammer and then the inverted hammer. So it takes time for these macro trends to play out. So if volatility continues to fall on stuff like the move and the dollar in the next, August, September, October still continues its depreciation trend, you're going to see this chart eventually breach the TWAP to the upside. And then heading into 2024, January, February, March, Q1, you're going to want to see a breakout to the upside, previous resistance holding as support, and then eventually heading into summer next year, the higher high. So this chart zoom out. Stop zooming. Maybe. Zoom. Okay. So you want to see the trifecta of bullish confluence: breach, retest, and then the higher high. So this is on the monthly chart. So this takes a long time to play out, which means patience, which means you're not doing much, especially on a daily basis. So that's the most important thing with regard to capital management. We'll end on a capital management note. Slow down. When you allocate capital, you better be prepared to allocate that capital for at least a month before you start to see what the hell it's doing. So if you're allocating capital to bullshit, like historically Doge and Shiba and Pepe, you don't have these types of stories to discuss about directionality and macroeconomic conditions, and maybe you could talk about those things from a liquidity perspective, and you certainly have to consider those things from this chart's perspective, whether it's a negative sum game. I mean, you're not going to have appreciation in those assets necessarily unless it's a positive sum environment. So this is critical. So expect continued depreciation. That's still the base case. And what you want to see, outperformance in a negative sum environment, is not depreciating significantly. Less depreciation than other shit in a negative sum environment is relative outperformance. And that will indicate to you the things that have a greater likelihood of surviving. And then when you see this at 10%, 50%, and you start to see the Ethereum total supply of dollar liabilities at 100 billion, 150 billion, a half a trillion, that's when you start to see your significant outperformance. And what will outperform more than everything else? The things that survived, that provide critical systemic functionality. Hope that helps, ladies and gentlemen. We'll check back in on Wednesday. Thank you all for joining me in this back to the office stream. I wish you all a good day. Tell everyone to subscribe. 23 people in the stream, 10 likes. Hit that thumbs up button. I will see you again on Wednesday after party on Discord for the most rational community in the entire crypto space. Links to Discord are in the description below. It has been a heck of a ride with that community. I appreciate all of you sticking around for the next cycle whenever it comes. See you on Wednesday. Peace.